Hi everybody, welcome to another update on the stock screener. Somebody gave a name on YouTube, Wesdome Gold Mines. I have not looked at it yet because everyone says that it's overvalued, so I didn't bother. But let's take a look right now. I'm going to do it really quick, just to see if it's actually overvalued or not. So first thing, always start with the balance sheet. That's always the first step. Canadian dollars, screenshot, so enterprise value is market cap minus current assets, 85 million. 85 million Canadian divided by exchange rate. Total liabilities 194 million. Yeah, 194 million. So plus 194 divided by exchange rate. So this company does have some net liabilities, not counting in the properties. Share count. Shares outstanding is, let's say, 150 million. Can check it here as well. $150, yeah, let's take 150. Okay, so market cap 1.6 billion, which is weird because, wait, we need to do this divided by exchange rate. This is in US dollars, this chart. So 1.2 billion market cap. Okay. Okay, so they don't have a lot of debt actually. 1.2 billion market cap. And the equity is only 400 million. Isn't that 3 times book value? That's pretty overvalued, if you ask me. But the good news is there's not a lot of debt then. It's only 80 million debt on a 1.2 billion market cap. So not a lot of debt, all equity or market cap. That's the first thing. Interest payments, let's see. Interest expense is 4 million Canadian per year. 4 million divided by exchange rate. Let's say 3 million US dollars. And they will pay it off really quickly, probably. Let's do this. Okay. Next up, let's calculate the all-in sustaining costs. So costs for the first quarter is 78679 divided by, let's say, 1.35. That's this. Corporate as well, plus 3969. Stock-based compensation. Let's add exploration as well. And then plus sustaining capex minus depreciation. What is depreciation? $24 million. Okay. Depreciation is 18 million US. So 18 times 4. Interest yeah, okay. So 72 million depreciation. What's the total capex? Screenshot. Total capex investing activities 30 million per quarter. Last year it was a bit lower, 25, let's say 25 million. Yeah, but it needs to be exact. So let's say 20, okay, so 21. So the growth capex is this minus sustaining. Let's see what's the sustaining capex. AISC was 1650. Sustaining capital was 2.9 million. I'm just searching the sustaining capital. Okay, I think this is the one that I need. So Q1, cost of sales was 78, yes, minus depletion of the 24, a little bit of byproduct deducted, then sustaining. Corporate in general 3.9, yes, that's coming from here. And they didn't add exploration. Yeah, maybe I shouldn't add exploration then. It's not in here. Okay, I could remove exploration. Probably this is in the growth capex or something like that. I will add it in the growth capex. So sustaining is 15 divided by 1.35 plus 4275. That's the sustaining, these two here. And then we get the all-in sustaining. Ounces of gold sold is 35700. So AISC is this divided by production. 1645 is exactly the same. So, okay, let's say 1650. 1650 for the all-in sustaining cost. Growth capex is total capex minus sustaining and is 6.8 million. 6.8 million times 4. So about 20 million capex. That's not a lot of capex, if you ask me. Wait, something. So depreciation is much higher than the growth capex, which is only 24 million. So 20 million in capex and 70 million depreciation. So they are depreciating much more than the capex. That's a weird thing. Normally this should be around the same. So not sure what's happening here. Tax rate. Tax rate is around, let's say, 3706 divided by 30% tax rate. Or yeah, let's just take 30%. That's a good rate. Okay, we're almost there. Gold price is going to be 2,400. Production, we had production is 3,570 times 4. And we have our results overvalued, double overvalued. But this is without the growth yet. So let's see how much they will grow. Capex was 20, AISE interest tax rate. And this is the result. Overvalued. EV to free cash flow around 20. If you want to buy an overvalued company, be my guest. So this is the situation in Q1. EV to NPV double overvalued. Now, let's take a look at possible growth. Canada, okay, a premium. High grade gold, yes. But high grades, and why is the all-in sustaining cost 1,650? Should be much lower. Yes, that's good. More cash flow in the future. Higher grades expected and lower costs. Let's see about that. Production 1.1 million per share. 1.1 per share. 1,000 per share. I don't know what kind of metric this is. There is some capacity to grow. That's good. That's also good. A lot of capacity to grow. Yeah, if they can do it times 4 and here times 2, yeah, then production could go up substantially. One, two, three. Where is this? 1,000. Yeah, 1, 2, 3,000. And 1,650 costs. So for this year we have 170,000. Okay, so they are ramping up. I will take 170,000. Looks much better now. A little bit higher. So here we can do 170,000. Costs 1,400, let's say. Nice. So costs are going to be lower. Impressive. And it's now even better. So they are reducing costs to 1,400. And indeed, it's looking much better now. It's PE of 10, which is good. Fair value. Sustaining capital 100. Is that in Canadian dollars or? I don't know, I think this is in Canadian dollars. Growth capital 20. Yeah, it's around 20. And sustaining capital is around 15 million, 60 million, and in Canadian dollars, probably 100 million. So yeah, 100 million and 20 million. Okay. 2025. It's going to 200,000. Wow. Wow, they are ramping up like crazy. 200,000. Then it's looking much better. So 200,000. Costs probably lower, but they didn't give any guidance on costs. I think it could go to, let's say, 1,300. Like this. And now it's fair value. Fair value. Last thing I need is mine life. Yeah, this is great. They can increase production. Okay, here we have reserves. 800,000 plus 500,000. Let's say 1.5 million. 1.5 million for Kina. And so ramping up. What's this? This is Kina. Some other exploration things. And more gold at depth. Then we have Eagle River. That will give 1 million. Yeah, 1 million. So around 3.5 million resources. 3.5 million. And production is 0.2. So mine life 17 years, around 17 years. And this production could, yeah, this could be 10 years. 10 years for this one, and the other one 35 could go to 70, and then yeah, 15 years for this one. So let's say around 15 years would be a good start. So we have 10. Yeah, let's take this estimate. Eagle River is going to be flat. It's Kina that is ramping up. Mostly Kina. Yeah, Kina can indeed increase production. Okay. So this is the, what is it? Eagle River complex mine. Yeah, I think this can be 10 years mine life, yes. New zones opening up. Only sustaining costs were pretty high, and now it's going to, oh, it's the other way. It went up, and now it's starting to reduce again to 1,400. Okay. So currently was 150,000. If they go to 200,000, that's up 30%. Yeah, I think 200,000, they could increase it maybe a little bit more. I will give it maybe 220,000, and that's it. Okay, so this is probably the end result. This is probably going to be the end result at 2,300, PE of 10, good mine life. But I don't see huge undervaluation for this company. It's fair value. EV is exactly the NPV. So I wouldn't buy it because it's fair value. Why would I buy it if it's fair value? Let's see what happens at 2,100 gold, because gold could crash to 2,100. Okay, it would only drop by 20%. That's acceptable. If it goes to 3,000, then the upside is 1.3 to 2. That's 50% upside. 50% upside. That's not enough for me. 50%. I would like to have 2 baggers, 3 baggers instead of 50%. So nice try. It is a good company. It's fair value, but it's not good enough for me. Let's add this to the upside chart while I'm at it. Production. You might wonder, what am I doing? I'm just creating the first data point at 2000 gold. Okay, second data point. These things are really easy. Everyone can do this. And it will give you immediately the upside, potential upside of this company. If you don't do anything, you won't know at all what the overvaluation or undervaluation is. So this is homework for everyone who is invested in gold miners. Okay. Now we add it to the chart. Wesdome. Wesdome EV. I would take this number. NPV 10. Market cap is about the same as enterprise value. And upsides. Okay, let's add it. And here's the result. Wesdome is this one. The green line here. It's currently fair value. It won't drop a lot if gold goes down, but it won't rise a lot when gold goes up. So not a lot of leverage. I just need to make sure which color I'm going to assign to it because I'm out of colors. I'm really out of colors. Yeah. How about black with this? Yeah, we don't have that yet. Black with, yeah, that could be a good color. All right, Wesdome gold added. So no upsides at all. So I expect this company to stay flat. Flat around here, and probably if gold goes down, could hit 10, and if gold goes up, it could go to 12, but that's it. It's not going to go like this, double, triple. Absolutely not. So I wouldn't buy it. And I'll see you in the next video. Bye.